Apple shares off to a rocky start this year, down about 6% since Tuesday, following two downgrades citing growth concerns and a general sell-off in the tech sector. Joining us now is an analyst who also downgraded the stock last year, Barton Crockett, Rosenblatt Securities senior analyst. Barton, good morning. You saw the writing on the wall in August, I think, before some of the folks that were out there. I thought it was interesting reading your notes. Reporting on Apple is like reporting on a small country, right? And there's all these different sectors out there. I'll just quickly summarize what I think I got, which is you think the valuations are high relative to historical norms, and you don't see the growth drivers. Give us some detail on that idea.
Look, I mean, I think Apple is a remarkable company, but I would argue that it's a stock that you can trade. You don't have to own it all the time. And I think you can do that because it's a maturing business. The growth trajectory is very much leveling out, and I think the combination of the growth slowdown plus valuation, which when we downgraded in August was at an all-time high, 30 PE, 1.5 times the market average. You did not need to be overweight at that point. Since then the stock's pulled back a little bit, but not enough where I feel like you need to kind of jump in. This is a business that's, going through cycles, and the cycle they're in right now is one of muted growth. It's a business that you'd love to own if they're, rolling out disruptive new technology, which they have a history of doing. But I don't think Vision Pro is that. I think Vision Pro is more a bunt than a home run. And I think the rest of the business, is fighting through some, choppiness. And as great as Apple is, I don't see them putting up the kind of earnings that's really compelling at this point.
So the biggest part of the business are the phones. And I guess you're not that excited by the growth rate of the phones. Talk about where it is right now, where you expect it to go.
Okay. So, I think the phone trajectory in the December quarter is one of flattish, not really much growth. And I think we're going to stay in that kind of trajectory through next year. And, and that's important, right? And if you're not growing in that line, if the trajectory there is kind of meh, which is where I think the consensus is at this point, even if they're hitting that kind of lowered bar, I don't think that that's going to be something that's going to be really compelling for the shares. A flattish iPhone, I think, is a really tough kind of setup. So iPhone is kind of there. I mean, it's really not a lot of excitement right now in iPhone.
So one part that looks like it's doing reasonably well or better is the service part of the business. And apparently Tim Cook's a little more excited about this. But that's not enough for you to get excited about the growth prospects for the company?
Look, I think services was tremendous in the September quarter. I do think a meaningful part of services is tied to search, the search ad market. And I think what we have there are increasingly difficult comparisons. So I think to argue that they accelerate from the September quarter is difficult in the face of that. You also have clearly a lot of regulatory noise there, the antitrust trial, some of the App Store regulation. So the headlines there could be a little bit problematic. The impact of that on the business, it's not something that you'd get excited about. Maybe you'd be a little bit concerned about what could happen there.
Barton, Apple's always a fascinating stock in the way it trades relative to fundamentals. Everything you've said has been true for some time. Of course, you downgraded it back in the summer, and yet the stock continued higher in this latest quarter. The valuation has gone up, and there's kind of this separate thesis on it, which is it's a super defensive stock in a tough macro environment, completely insulated from the rate pressures or anything else that's going on out there. And at the same time, Berkshire Hathaway owns 5.9%. They're not selling any. Apple buys back stocks from the rest of the world. And it's sort of this magical, melt-up machine. On the other hand, the stock does nothing for 18 months at a time, 2 years at a time sometimes. And so it has been this tough one to trade. How do you approach it with all that?
I think it is okay to trade it. I think when the valuation is stretchy and the growth trajectory is unimpressive, it's okay to ease up on it. If the stock were to pull back a lot, you could get into it even with kind of muted growth. I think you've got to look at it much like you would other consumer products goods companies where you're not in there all the time. You're there when it makes sense. As for the macro, Look, I think if we are in a more difficult macro, if the economy were slowing down and the stock, we're certainly no more expensive than it is right now, maybe a little bit cheaper, one could get more interested in it as maybe a relative kind of stability kind of CPG play. But that's not what we're feeling right now. We're feeling that the economy is pretty good, pretty Goldilocksy, and that's maybe not the defensive argument for Apple. And I think the growth argument for Apple is also challenged right now.
Got to go, Barton. But do you have an entry point that you feel comfortable?
So we've got a 189 price target, and I'd like to see double-digit kind of opportunity to our price target. I think you'd have to see a little bit lower for us to get more interested.